and they can change these board of directors as well. If they are not satisfied with the performances, they can change the board of directors. And board of directors are eligible to select CEO, which is among the board of directors. One member would be the CEO, who direct the companies and make the company on the right track, and who devises a strategy for the future of the company. So shareholders' right, they have a voting right. So they have a voting right to elect board of directors. If I want to be the board of directors, I ask shareholders to vote for me. It's like an elections. Shareholders are eligible to receive dividends. So dividends are different from the profit, right? Company earns profit, and how much company shares its profit to the shareholders, stockholders, that is called dividend. It can be 100% payout, can be 5%, can be 50%. It's up to that one. Liquidation. If company is dissolved, shareholder rights are that it's at the last. First of all, they have right to receive after payment of all the liabilities and all the stuff, right? So if company is dissolved, company first pay the government fees, the lawyer fees, then it pays bonds, loans and all the stuff, company salaries, worker salaries, everything. And if money left, then that money will be distributed to the shareholders. Preemptive right, or preemption, which means right to maintain one's appropriate ownership in the organization. So it doesn't mean that if you hold 1% share, you can go to the company and can say that this AC or this plant belongs to me because I own 1% of the company. This table is mine, this AC is mine, this laptop is mine. You cannot say that. So if this is a laptop, everybody have a proportion to that one. You cannot claim the property. You will sell the property and distribute the money. So it's proportionate, right? If you hold 1%, you are 1% owner of the company, not 100%. And that doesn't mean that if I have 1% ownership, I can go to the company and say that, oh, this is my company. Run the company like I want. No, you only represent 1%, right? Company is run by managers, and who select the managers? Board of directors. If you want to change the management, you go for vote, change the board of directors, and then board of directors change the management, right? So paid-in capital, like I told you, paid-in capital, which is also called contributed capital, that how much from the authorized capital company has issued, that's it. So how much people have contributed to the company, right? So paid-up capital, owner's equity consists of paid-up capital plus retained earnings, all the earnings that company retained over the years and did not distribute to the shareholders. So retained earnings are reduced by dividends, right? So the paid up capital also includes any additional paid capital, any premium whatsoever. We'll talk about here. So this is one share, it looks like. So one share value $0.05. Right now, this is this is the age of IT technology. We have e-shares, but in old times it is printed. One share is going to be printed, and it's like sealed by the state law, the company law, and here the owner name is going to be given, company name is there, number of shares will be given to that one. One share is equal to 0.05. Everything would be written here, and it has a serial number as well, like a currency note. This is like a currency note for a company share. C, shares. So common versus preferred stock. So there are two kinds of stock. One is common stock, one is preferred stock. Common stock, which is more of its name like very common, which are issued to public, right? They have the four basic rights: vote, here, vote, dividend, liquidation, and preemption, right? But for preferred stock, they have, in addition to these four, they have right to receive dividend first, and dividend, like fixed dividend. It's a kind of fixed interest, but we don't call it fixed interest, we call it fixed dividend. Whether company earned 1,000 or 1,000 million, company is going to give them fixed dividend. That's it. The dividend on common stock can vary up and down. Company choose not to pay, but for preferred stock holders, company must give them dividend, and based on pre-arranged or fixed rate. So only a few corporations issue. Those corporations who are struggling or who are new, they mostly issue preferred stock. Now we are coming towards numerical part for accounting part. So if we compare the common stock with the preferred stock and with the long-term debt, so what is different and what is common here? So obligated to pay the principal amount. Principal amount, we are in common stock, companies are not liable to pay you your principal amount. Same with the preferred stock, you are not eligible to return, they are not eligible to return the money. But for long-term or bonds payable or company loan or bank loan, yes, you are eligible or you are obligated to pay, not eligible, you are obligated to pay the principal amount, right? So if you see the preferred stock here, only 9% of the corporation in US issue preferred stock, and 91% issued the common stock, not the preferred stock. So on common stock and preferred stock, we issue dividend. On debt, we issue tax, right? So on tax, these are tax deductible, which means before going to the profit, before going to tax, we deduct interest first, and then we have a lower profit, so our tax will be lower. But in case of preferred stock, there is no tax benefit because tax is less after the tax, because dividend is less after the tax. So we have a profit here which is coming after tax. So tax is deducted here and then we pay dividend. So we don't have any tax benefit in case of common stock and preferred stock. So obligated to pay dividend, you are not obligated to pay dividend on common stock. Similarly on preferred stock, but you must be paying dividend on preferred stock. Maybe this year you are not paying that, but next year you have to pay double because that will be added to the, this is in working area. But in common stock, if you decide, if all the shareholders decide that company need finances, we are not sharing our profit, so dividend is not going to be declared. But interest would be on long-term debt and it must be paid, right? So par value or no value, shares are issued in two ways, either with par value or either without any par value. So, for example, if the par value is $10 and you need $1 million, how many shares you need to issue? Divided by 10. Answer would gonna be $100,000. 100,000 shares you need to issue in the market to raise $1 million, right? But what if there is no par value? That's it. How many shares you need to issue? You said only we are going to issue 100 shares and we will be receiving 1 million. 1,000 shares we will be receiving 1 million. But what is the value of per share? Per share is not value is mentioned, not mention anything. So we will be clarifying this through illustration here. So let's deep dive into actual accounting for issuance of stock. So our lecture of accounting starts from here with the second learning objective. Previous was just for definition, which most of you already gone through different subject, introduction to business or company law or something, right? So let's do that. Account for issuance of stock. Here we go. So Home Depot needs to raise $100 million through issuance of stock. Suppose Home Depot common stock had a carried par value equal to $10 per share. So $10 per share, you divide it by 10, it means 10 million shares they need to issue. Right? So when they issue, they receive cash. So entry would be cash to common stock. Right? Cash to common stock. 100 million, 100 million. Simple. Cash is an asset. Asset increase debit. So cash is debit. Common stock honors equity. Honors equity increase credit. Common stock credit. Right? Now, so here the common stock was issued on par value. Par value. What if they are issued above par? Now, Home Depot needs to raise $100 million. Suppose Home Depot common stock par value is 0.05 and the company issues 10 million shares. So what is the par value of those shares? 10 million shares multiplied by 0.05. Answer 500,000. So they issued how much shares? Common stock $500,000. But they receive $100 million. So it means they receive 9.95 million above the par value. So we call this paid in capital. In bonds payable we call this premium, but in common stock we don't call this premium, right? Because otherwise we will be confused whether this is a bonds premium or this is a stock premium, right? So we use the word paid in capital. Paid in capital in excess of par or just paid in capital, right? So if the share price is 10, the par value is, you less the par value, answer gonna be 9.95. 9.95 multiplied by 10 million, answer gonna be, so this would be their paid in capital in excess of par, and the par value is only 500,000. That's it.